You're 80 years old and you're retired. You've built up $900,000 in your 401k, and you're still asking yourself a very important question. Should I convert this money to a Roth IRA? That's what we're going to look at with today's video. Welcome, my name is John Vandergriff. I'm one of the owners and wealth planning team lead here at Blue Ridge Wealth Planners, where we help people create plans to transition well into their retirement years, or if they're already in them, to effectively plan for the things that are affecting you on a daily basis financially so that you can continue to enjoy those retirement years. So one of those things that is a very important conversation that we're having today is in the realm of taxes and tax planning, centering around things like Roth Conversions. So we're going to focus on that today. And so if you get value out of this video and you look at it, what we would ask you to do is share it with other people, subscribe, or even comment below so that we can know, obviously, some feedback from you, but also get this message to other people and see if we can help them in the same way that we're providing value to you. But with that being said, I always tell people when we do videos like this, make sure that you are consulting some other professionals, because taxes, we're going to look at some examples here, but taxes can be very complicated for an individual person. And so make sure you're consulting a CPA or accountant that you're working with. We always work hand in hand with our clients to make sure we have all the information we can whenever we make recommendations like what we're going to discuss today. So with that being said, we're 80 years old, retired with $900,000 in 401k. Should I convert to a Roth? Some people will say no because, quite frankly, you're too old and you may not get the benefit out of it, which isn't exactly true, because when we look at this, these dollars are going to have taxes paid. Whether you do it, your kids do it, I guess the only way out of it is if you give all this money to charity. But as we look at this, we need to make sure that we're making good strategic decisions for the best stewardship of these dollars, regardless of age. Okay? So as we look at this, these are things that we talk about in what we call a plan for everything. This is a sheet that we normally fill out with a lot of information for individuals. But with a plan for everything for retirement, you need to really make sure that you plan for income, investments, taxes, healthcare, and family and legacy. And even though we're going to spend most of our time focused on the income and tax ramifications of that today, you're going to see how much interconnection happens between all these different buckets. Therefore, you need to have a plan that's going in the same direction in all of these areas. And so as we dig into this situation a little more, we've got a married couple here, 80 and 81 years old, lots of time together, hopefully lots of time left. Between them, they've got pensions that total $5,000 a month, Social Security income that also equals that $5,000 a month mark. And so between those two, they more than provide for the income need that they have, about $100,000 a year. So effectively, for their lifestyle, they don't need either of these buckets. But because this couple is in the RMD phase, they will have, at this point, a little under 5% that they are forced to take out of this 401k this year, and then an increasing percentage every year after that. So their 401k actually could have been larger than this, but because they've been dipping into it, or forced to dip into it at the age of 72 now and after, they're having to take withdrawals that they really don't need just so that they can pay tax on it. So what we want to do is, if you're forced to take those withdrawals, we want to effectively use those monies, but also see if we can lessen the burden of that and make the overall best tax use of the dollars that we have. So when we look at this, some people think, oh, well, if somebody's 80 or 81 years old, they actually can't do Roth conversions anymore. They're too old, they're taking RMDs, and they're not eligible to. That's actually not true. You can do Roth conversions at an age that requires RMDs, which today is starting at 72. But if you do that, you will have to first satisfy the RMD that you are forced to take out before you can do any Roth conversions above that. You can't do the Roth conversions first and then the RMD. You've got to take it out, but and we have to recognize the RMD monies are not eligible for Roth conversions, because some people think, oh, well, I'm forced to take this out, I'll just go ahead and pay the tax and then put it in my Roth account. If you want money to go into your Roth from your 401k or IRA, it has to be in addition to the required minimum distribution, not the required minimum distribution, or as we call it, RMDs. Now what's nice, the RMDs can be used to pay the taxes on the conversion, so it could be used in that way, or you could give some of these monies to charity through what's called a qualified charitable distribution that would actually avoid them being taxed, and then you could be able to do a Roth conversion with very minimal impact from the RMD, but that could be more money than you want to give to charity depending on the situation. So as we look at this, as we start to plug in this information to our plan for everything, you notice that this couple has $100,000 that they need between Social Security and then pension combined. We've got $120,000 of annual income. The taxable portion of that, based on where we're at, is actually right at $110,000 or $111,000. So I'll go ahead and fix that, which would put them in today's brackets at a top rate of 12%. And so as we look at that, 12% is a pretty good tax rate to have, especially on 6 figures of income. But anytime they take RMDs, that RMD is starting at 12%, and then it's actually increasing them up into the 22% bracket. So they're forced to take out money from this $900,000. They don't have any taxes that they have to, or money they have to take out on the $100,000 that's after tax. They currently have zero money in tax-free accounts like properly structured life insurance or Roth IRA positions. So the question becomes, does it make sense to start migrating monies from this pre-tax money and be able to hopefully get it into a tax-free bucket more than just putting it after tax when it factors in their RMDs? So as we look at this, obviously what matters in this discussion is what taxes we pay. We don't know where the future holds, unfortunately, but we do know where taxes are now, and we do know where taxes have been, and that can give us a guide of whether a Roth conversion makes sense for this particular situation. So what we're looking at, this couple had taxable income of $111,000, so they're at a 12% bracket going into a 22% bracket with their RMDs. If we look at here, the way the brackets were in 2017, and the reason we use this as a number is because if the tax code that we are experiencing now expires after the year 2025, it will revert back to the way things were in 2017, and these brackets have been adjusted to be for current income. But as we look at it, that would put this couple in, at minimum, the 25% bracket, and then up depending on how much they're forced to take out of their 401ks moving forward. And then, just so that we have something to compare to a higher tax environment, we're looking at 1981's tax brackets to see, today, the highest tax percentage we have is 37%. You'll notice that the top tax dollar then was 70%. And the reason I'm showing you a tax increase here is because of two factors that are not great going on today between overspending with our government on an annual basis and then the repeated overspending that is built to a very large debt that is topped over $30 trillion. We have a tax problem or a debt problem, and the only way to fix that is to increase taxes, which for you becomes a tax problem because it increases the amount of taxable or taxes owed on the income that you bring in. And unfortunately, I don't think that this is just an ultra high net worth problem. I think that we're going to redefine who the ultra wealthy in our country is, and it will be a much lower threshold than you think. So as we look at this, because of tax increase coming in the future, we've got to look and see if taking monies out of 401k or IRA accounts makes sense to do more than just their RMD, but also look at maybe, does this make sense to convert to a Roth? So in this case, let's say we've got $100,000 that we're considering, just for a round number's sake, moving into a Roth. We want to look at the ramifications if we made that move versus if we did nothing. And again, we're assuming we're already taking our R&Ds out, so we don't have, or all of these monies are eligible for Roth conversion. So again, if we choose to go the route of leaving it in the 401k, no taxes are owed on that money now, so it's $100,000. If we did a $100,000 conversion, it would go on top of all the taxable income, on top of the RMD, and add another $100,000 of income. And for today, let's just assume the effective tax rate was 20%, so we have a round number here, and that tax is paid from the conversion. That means you would start the Roth account with $80,000 versus $100,000 staying in the 401k. So I've had many conversations with advisors that will actually stop here and they'll say, see, this is why Roth conversions are bad for clients, because if the market goes up this next year, they're going to actually make less money in the Roth than they would in the 401k. market goes up 10%, you make 10,000 here, you make 8,000 here, which is true. But it ignores a very important detail of these not being the same type of tax buckets. This side is growing tax-free, this side is growing taxable, so that 8,000 that grows here is not the same as the 10,000 that grows over here. It could be better, it could be worse. We've got to see at the end. So let's assume that both of these accounts are invested the same way, and it's at least 5 years so that our Roth bucket is tax-free, and our 401k accumulates to $200,000. The Roth jumps to $160,000. So again, so far the financial advisor that said not to do a conversion is right mathematically until we go to take this money out. So again, the Roth, there is no taxes owed. So again, no taxes. So $160,000 is what you have available to you out of that Roth account. The 401k, it depends. It depends on what the taxes are at the time that you take the distribution. And so as we look here, what's ironic is if the taxes at the end were the same 20% that they were at the beginning, you will notice your bottom line is exactly the same in either scenario. So what we've got to find for the individuals we work with is when can we have the lowest percentage of taxes paid? Is it now or is it later? And so again, since we don't know to the full extent what the future holds, we have to look at the past to determine what will most likely give us the best tax situation. Because the way that we normally get advice in this area is people say, oh, well, your income is going to be lower in retirement than it is when you're working, and so why not wait until then to pay your taxes? Don't pay it while you're making really good income. Well, again, because of Social Security, these people have pensions and RMDs, they may actually show a higher taxable income in retirement than they did when they were working, because they're forced to take and generate income that, in this case, they don't need. So as we look at this, if that age-old advice is true and you do have a lower percentage of tax owed in the future, you would actually have a higher amount of money leaving the money in a 401k than you would if you converted to a Roth, even though this money is growing tax-free. So as we look at this, it is truly a discussion of when can we pay the lowest percentage tax. Now, because of the large amount of overspending that's happening and the debt that is taking place and not going anywhere, I think there is a very high chance that even if your income stays the same, you could have a higher percentage of it that goes to the government. And so if that's the case, making that conversion now while the tax rate is lower than it will be later gives you a higher dollar amount that stays in your pocket, and also gives you some different options because you no longer have to take distributions from a Roth account because you've already paid your taxes. So you could invest this for future growth, or for this particular couple, let's say their aspiration was to give this money to their children. I know 100% your kids would rather inherit a Roth account than a 401k because of the tax ramifications it brings to the children. So again, depending on, and this is where kind of family legacy planning comes in, tax planning, we could have potentially the best, cheapest, most efficient use of these dollars by paying the taxes now versus even the kids inheriting them later at a potentially lower amount or a lower tax position. So, because again, we may not have a lower tax position later. So as we look at this particular situation, even though these people are 80 and 81 years old, their dollars start at the 12% bracket, but then bump up to the 22%. 22% and 12 is still less than 25, and noticeably less than the 37% bracket that this family would jump into once you factor in their income and the RMDs on top of it. So as we look at it, how much to convert? Well, this family has taxable income, as we said, of $111,000. Their RMD off of that $900,000 would be $44,500 and change. So that would actually bring their starting income to $155,000. And if they wanted to convert and stay under that 25% tax rate, they could convert 22% at 62, almost $63,000. That would be in the 22, 173 that would be in the 24. They would take a noticeable chunk of that $900,000 and move it into a Roth position with an effective tax rate of conversion at 23.5%. So again, we don't know how long we're going to have the opportunities, but if we jump to a 25% bracket, the move here makes a lot of sense because it's just getting those dollars out at the lowest tax rate that we can find. That's the goal when we have this discussion. Now, it's not the only thing that we have to consider, and this is why many times we recommend getting help with this discussion, because what you see here, this is a chart that shows the implications of what happens to Medicare Part B when your income gets higher. So once you get past the age of 63, the Medicare is going to start doing a 2-year look back on your income every year to determine how much Part B premium you should pay or have deducted from your Social Security income. So this married couple, both are in Medicare, so they've got a $3,900 cost for Medicare Part B every year, or this particular year, and then if their income goes higher than $194,000, they actually have an incremental increase depending on how high that income gets that they would have to add on top of the $3,900 that they pay baseline. So again, this doesn't necessarily mean that you shouldn't do a conversion, but you better factor in these costs on top of the taxes that are generated, because that is your true cost of converting this money from a 401k to a Roth position. And so you want to be able to have all that information on the table to make sure it's still a good deal for you. But again, these are the things that we're talking about on a daily basis, and that's why there's a lot of complexity around this conversation. But as you see here, just because this couple is older does not mean that they should not do a Roth conversion. It's all about when can you pay the lowest tax, no matter how much time you have left. So again, if you want this money to go effectively to the next generation, you can pay a lower tax now than they will. That's a good use of those dollars. It costs you something. I know some of our clients have said, they can deal with it once they get there, and that's fine. But if you're trying to find the best time to pay the taxes, it may be today. And so if you've not had anybody talk to you about that, we would be happy to have that discussion with you to see how we can help you make a good decision, whether it's to stay in the 401k or to maybe do some Roth conversions and put that into a position where it starts to grow tax-free. Most of the time people aren't having this discussion, or at least not sharing the actual details of how to do that. And so if you need help in this area, you're going to see a link pop up. I would ask you to click that. That will get you a time where you can talk to one of our wealth planners, and we can go through a process to see if now is the best time to do this, and then help you build a plan of how to do that in the future. And so thank you for joining us today. Hopefully you learned some things in this video. Be sure to like, share, also comment below and give us some feedback. Let us know what you think or what questions you have. And we look forward to sharing more content like this in the future. So stay with us and continue to watch along. But as far as what we're talking about today, that's all we have. So thanks for joining us, and we'll see you next time.